Okay, folks, good morning. It is Wednesday the 18th. It is FOMC rate decision day. For those out there worried about they're going to raise interest rates, don't. There's pretty much a zero chance. It's all about the announcement. Every single bit of today's news will be about the words, not about the number. So let's just start off with a little bit of humor. This cartoon here, we have a global audience, so I figured I'd start off with an introduction to our conservative hawk, Ryan here, Paul Ryan of Wisconsin, congressman. He and the Democrats just cut a budget deal, which is the worst nightmare for the American people and, frankly, for the Federal Reserve. Because remember that the Federal Reserve used the last go-around, the looming so-called government shutdown, as a reason why they would not taper. Think about it. The Federal Reserve just appointed themselves this year the fourth pillar of government. Congratulations, Ben Bernanke. But this cartoon here really does illustrate this situation here in this country. Spending completely out of control and getting worse. And that's with the assistance of the Republican Party. And even the Republicans are turning on the fiscal conservative. So we have serious problems in this country. So a quick illustration. Here, this picture here is the macro picture. This is reality. Our spending is out of control. Our debt is a reality. And we are getting ready, as Paul Ryan here is illustrated, is getting ready to drown. That's a fact. And the reason why Washington is able to do this is because it's enabled by the Federal Reserve. The Federal Reserve keeps rates artificially low. The government keeps borrowing at ridiculously low rates and just blows the money. No new roads, just on social programs. So this is the reality. This is our future. So you might say, well, the probability of the Federal Reserve tapering effective today is very, very high. And one might think with this reality that that's the case. But let me show you a chart. Here's the other reality that they don't report. They don't report this as the reported number. This is the real unemployment rate in this country. In black here, you have the U3 number, Bureau of Labor and Statistics U3 number. You can see how conveniently it's a nice decline. However, over here in red is the U6 number. Again, I didn't make this chart. This is on the Bureau of Labor and Statistics. This is their data. The U6 number measures those that are underemployed or part-time. This is the real unemployment rate in this country, and it's not the reported rate. This is the reported rate. So this is the other reality that Ben Bernanke wakes up to today. Can he really taper with unemployment, real unemployment? And this is the lower estimate that I use. I have other estimates that are up in the mid-teens, but I won't use those. I'll use the government's own data. Can he begin to taper? Is the economy really organically that strong? Now, keeping the chart of the unemployment rate, real and reported, in mind, now let's take a look at the Fed's policy since 2008. And here is the obvious. We are at near zero on the Fed funds rate. There's only one problem for the Federal Reserve. Take a look at the PCE. This is similar to the CPI, backs out food and energy. This is their preferred measure of inflation. We're hooking up. Conveniently, this backs out food and energy. I guess in Washington, they don't eat or use fuel because in their reality, it doesn't matter. So using their own benchmark of what inflation is in this country, it's an absolutely ridiculous measure. But you could see that we're hooking up. So here's the quandary that Ben Bernanke finds himself in. Inflation is hooking up. The yield on the 10-year bond is now nearing 3%, which is my target for the year, this time last year. Yet unemployment, real unemployment, remains at 10%, above 10%, using the U6 data. So what's the man to do? What is his decision here? Raise rates and possibly put more people out of work? Raise rates and possibly kill what's left of the housing sector? Has anybody seen the chart of the new home builders of late? Let's take a look at it. This is the housing sector, the HGX. Take a look at this. We peaked out back in May at 210. We pulled back 20%. That's a bear market in housing. Think about this. $85 billion per month spent, wasted by the Federal Reserve to so-called fix the economy, yet the housing sector remains in a quagmire. Now, normalized, if interest rates were rising, one might assume that the economy is improving as well. And it's not a bad thing. The Federal Reserve would step in the future and cool things down. So what Ben Bernanke needs to do today is ask himself the question, is this economy really growing organically? Are interest rates, as noted here on the 10-year Treasury bond yield, monthly chart. This is a huge move in 1 year, folks. A massive, massive move. Is this move due to the anticipation of Federal Reserve easing? Or is it in reaction to a U.S. economy that is growing organically? And if it's growing organically, unemployment should take care of itself, but it's not. If it's growing organically, the housing sector should grow on its own. But I showed you in the chart, it's not. So in closing, keeping these thoughts in mind, I don't think that the Federal Reserve can taper. And in fact, if we do rally, and I don't know how much weight of power the Federal Reserve has over the 10-year yield, it's really more so over the shorter duration bonds. But will Janet Yellen, when she comes in, will she actually need to increase bond buying? And if you hear any type of speculation out of the Federal Reserve about additional bond purchases going into 2014, expect a rally. If there is no talk of additional taper, yet the policy remains unchanged, then the question then becomes, what's wrong with this economy? We've been in 5 years of Fed accommodation, emergency accommodation. What's wrong with this economy if it's growing organically? That we need this type of fiscal policy. Okay, to the charts now. The key charts that we're watching today, IWM, really the banks and the IWM, the Russell 2000, because as goes the Russell 2000 and the banks, so goes the rest of the stock market. The Russell 2000, so far a good week. We're right at that upper band of the declining downtrend channel. One might say it's making lower lows and it's in a new downtrend. I don't know. It looks more of a flag formation to me. So weekly chart is still in an uptrend. This looks more in favor of a flag formation. We get a breakdown below 109.32. Then I'll buy more into the breakdown school of thought, but not until then. Weekly chart of the banks, you could see that they're not having a good week. They're down this week. RSI broke down below the lower band of this pennant formation. Yet we haven't made a lower low in terms of price. So this is a case where you have, and the week's not over yet, we still have Thursday and Friday, and Wednesday, of course, for the XLF to rally back and closed unchanged on the week and possibly correct this breakdown on RSI. But this could be a case where you have an indicator leading price performance, and that does happen. So midweek anyway, the banks aren't looking good. Again, no price breakdown, just the RSI is breaking down below that lower band of the pennant formation. Now what we're also seeing, and these are my last two charts, on the S&P 500, we're slightly up on the week. However, what you're seeing is, and this is not a bearish chart midweek when we're going into Wednesday, see the topping tail? So we're off the highs of the week. Let's take a look at the daily chart. And I want to show you a divergence that's going on. All right, daily chart. You can see that we're setting up for a possible lower high inside day on Tuesday. No new high, no new low. Topping tail on Monday, implying we have some sellers up here, those who want to be made whole. Indicators are not looking good. The VIX, and this is where the divergence comes in. We're up slightly on the week, and this divergence is far more pronounced on Monday because you had the stock market up reasonably and the VIX was up reasonably on a weekly basis. You still have the VIX up as well as the S&P 500. So you have some buyers in here seeking protection along with the stock market being up on a weekly basis. So a little bit of a divergence, something to keep an eye out on. You have some nervousness entering this market. And that's it, folks. Stay tuned, and we'll see what the Federal Reserve has to say today. It's going to be a very, very interesting day. Have a profitable day.